Hey, well, welcome to National Black Business Month. My name is Xavier Tosin. I'm the chairman for the African American Chamber of Commerce here in San Antonio, Texas. Super happy to be here today to bring yet another webinar that will help support Black-owned businesses within our community and perhaps across the nation. Here in San Antonio, with our chamber, we believe that we're stronger together, and our collective efforts will help elevate the Black enterprise within this city. And also throughout the nation as well. So we're super excited to bring these educational webinars to the table so that folks can benefit from them. As we build along the way, we will be answering questions. So if you see this either on Facebook or YouTube, feel free to ask or pose a question so that we can bring it up at the time after our guest speaker comes to the table. So at this time, I want to bring on Mr. Luther Johnson, who is our presenter today. Super happy to have Luther with us today. Luther is with New York Life. He's a financial services professional. And today he's going to be talking about business planning. And so we all know that to reach something, you have to have a plan. And if you don't have a plan, you are probably planning to fail. So we don't want that to happen. And so without further ado, I want to thank you so much, Luther, for joining us today. And feel free to introduce yourself to the audience.
Thank you, Xavier. Is my screen being shared? Awesome. Okay. Well, thank you so much for joining us. And just like Xavier said, nobody plans to fail, but sometimes they fail to plan. So if you are a serious business owner, an entrepreneur, if people depend on you for their paycheck, you need to pay close attention to some of the actions and strategies I'm going to go over with you today. So you might wonder, who in the heck is this Luther Johnson guy? Well, my education, I first earned a Bachelor of Fine Arts from the Columbus College of Art and Design. I earned an MBA in e-commerce, and I am also a PhD candidate with a focus on business finance. As far as my accomplishments, I am a agent, a financial professional with New York Life. And in that role, I earned the Long-Term Care Achievement Award. I also earned the AAMU Black Excellence Gold Award last year. I have a 10-year banking technological background. I was a project manager in the software division for a number of years. Some of you might even be familiar with some of the software applications my team put together. If any of you have ever deposited a check via your cell phone, my team at USAA helped to develop that software, and we licensed it to other companies. So that was something that I actually had a piece in. I have a background in project management in software. I am SAFe certified. That is an agile product management approach. And I'm also the co-author of Becoming Chocolate Barbie. That is a guide for professional women in the music business. So I have a deep background, and I passionately try to talk to as many of our people as I can, as quickly as I can, because the major thing separating our group from other groups is our access to cash and our businesses. Now, I need to mention this disclosure slide. We take this slide very seriously, and it is critically important for you to know that I'm here to educate you on some important topics. However, none of the strategies should be implemented without first seeking and relying upon the advice of your attorney, tax advisors, and any other professionals for your particular situation. So I am here to guide you, but by no means do I have all of the answers. There's an old saying that I love: a strong teamwork helps the dream work. So you need to have a strong team to help you achieve the heights that you want to aspire towards. Now, we're going to talk about the topics involved with owning a business and what types of issues are common. First, we will discuss the team approach to business planning, putting together a team of advisors to best serve you. Next, we will discuss the typical business owner's goals. Thirdly, we will discuss business continuation, the legacies, and by looking at some of the most important issues that some people might encounter. Next, we'll talk about issues involving the loss of key employees. A key employee is that person that really makes your business sing, and without that key person, things will slow down and maybe even grind to a halt. And finally, we will review employee benefits, which may help a company attract and retain employees in the long term. Now, in dealing with the advanced planning issues, it is wise to get help from the various disciplines in the financial services industry. This is true because team planning is a more professional approach that involves advisors at an early stage of the discussion. There won't be any surprises. Such an approach typically has fewer surprises throughout the process, since all of the team members are helping to build a solid business plan. And it also helps provide a more complete and comprehensive planning experience, and it can be done with a team looking at the issues from various different perspectives. We've all heard the saying before, 4 eyes are better than 2, and 6 eyes are better than 4, and so on. It always helps to have more eyes looking at your plan to make sure that everything is bulletproof. And having everyone on the team should give you a peace of mind that you are truly making the best decision that you can. Now, you might be thinking to yourself, what are my team members? Well, although the individual tasks of these professionals may be blurred a little bit and they may overlap during the actual business processes, each team member will typically bring a specialized perspective and expertise to your final decision. At the center of the business planning team is you, the business owner. You're the boss. You're like, the team owner. The life insurance professional, in many cases, will act as a facilitator to help the team run smoothly. That would be someone like me, and someone like me would quarterback the entire effort. The attorney will help with the legal opinions and the experienced guidance to help prepare the various legal documents. Accounting professionals will help advise the business owners on the tax and reporting issues and provide the numbers for the team members to perform their tasks. A business appraisal expert, and this is huge, is important to determine the actual value of the business. Sadly, in a lot of our businesses, this goes overlooked. The team members' importance increases greatly when the business is transferred between family members. The IRS scrutinizes heavily in this area, and I will get further into this as we move along. A financial planner may be involved to help integrate and coordinate the business owner's personal assets and the business plans. Bankers might need to put on the team in case you have some financing and lending issues. And remember, all decisions are actually made by the business owner. So you're the boss, and nothing goes down unless you say it's okay. Now, the goals of the business owner are very simple, and they're pretty similar across most businesses. Generally, owners want to make money to provide for their family, the owners, and the employees. They also want to grow the business, and they want to continue that business long after they're gone. They want it to move beyond the first generation. This is an aspect where a lot of us missed the boat. A lot of businesses die with us. So I'm trying to help you through that right now. Now, what is the success rate of continuing the business into the next generation? You might be asking that. Well, according to several studies, roughly 33% of family businesses make it to the second generation. That means 2/3 of businesses die with the owner. And that's businesses just all across the board, American businesses. There's an old saying in the Black community, when mainstream America catches a cold, Black America catches pneumonia. Negative statistics, sadly, often impact us worse. So if it's 33% of family businesses that are American that go on to the next generation, it's likely it's maybe half of that of Black businesses. That's just something to keep in mind. And that's why this presentation is likely to be so important to those of you that have joined us today. Roughly between 10 and 15 pass on to the third generation. So it even gets worse as generations move on and go by and by. So just keep that in mind. Now, you might be thinking to yourself, why do successful businesses fail in the first generation? A key reason is the lack of succession planning. Just like I said earlier, we don't plan to fail, we fail to plan. If something happens to the owner, what happens to the business? Should the owner sell? And if so, who would they sell it to? Will the estate receive adequate compensation for the value of the business? Will the purchase price be enough to support the family in the manner in which they're accustomed to? These are questions that really need to be addressed. Or what happens if the family members retain the business? Who will run that business? If the business is transferred to a family member or groups of family members, will the distribution be fair and even across all family members? Or will there be an unfair arrangement of assets upon the original owner's death? Finally, can a family continue the business without that key person who started the business to begin with? This is huge. This is huge. Now let's compare what conflicts could exist at the death or departure of the primary owner. The heirs want, and this is if the business is sold, what the heirs want is for a top dollar for the deceased owner's interest. They want prompt payment so that they can continue to live their lives as normal. The value of the business and solid tax purposes in order to decrease the likelihood that the IRS will determine a different value. You know, what would really suck is if you think your business is worth $1 million and the IRS says, is only worth $750,000, that pretty much jammed you up. So there's something to that. And it can work the other way around, where if you think it's worth $750,000, the IRS says it's worth $1 million, that increases your tax liability. So you want to make sure that you appraise your business properly. Another thing that the heirs want when the business is sold is they want to make certain that their interests are protected. And heirs don't want to take on any other unnecessary business risks. Now, what would the surviving owners want if the business were to be sold? Well, they want to pay a fair but minimal price for the business, and they want a prompt transfer of the business so that the operations can continue uninterrupted. They don't want any slowdowns. And if the ownership is maintained by the family, what management wants is they want to be able to control the business without the heirs telling them what to do. Nothing can be worse than a family member who thinks they have some sort of authority dictating how things go when they're not an expert in that business. Sadly, that happens all the time. And what management will want is that they will want the business to grow and to continue the lines of credit that are already in place. Otherwise, management might be forced to change the long-term plans of that business they just acquired. And finally, they want to maintain the current customers the business has, the current employees the business has, so that there is a tiny bit of interruption, virtually no interruption in the operation of the enterprise. Business owners will have to take on the decision whether to keep the business or sell it. What are the choices? When an owner leaves a business, there are basically 4 possible successors: other family members, the current co-owners, the key employees, or you can sell it to an outside third party. Without proper planning, businesses are often forced to liquidate, and in many cases, this is the worst option. Now, you might be thinking to yourself, why should you start planning now? You might be thinking, I don't intend on leaving my business for another 10, 15, 20 years, but what if something happened to you? What if you were afflicted with an illness? What if you developed some sort of a stroke? What if you were unable to continue working? Would you, your family, or your company, or your employees be ready for such an event? There are a lot of people depending on you if they are your employees, and you need to make sure that you protect yourself and make sure that you put together an imperative plan that is both short-term and long-term. Now, proper planning can provide you all of the following. For your family's immediate and future security, it can determine who will be the successor. And in many cases, you might need to develop a successor. You might not have a successor on deck yet, so you might have to develop one. You need to carefully establish a value of the company that can stand up to IRS scrutiny. I mentioned this at the top of the presentation. The price cannot be too low between family members because the IRS will scrutinize that transaction. And if it's too low, that's not going to work, and Uncle Sam is going to want his cut. So don't think that the business can actually be worth $1 million and you think you can sell it to your nephew for $50 trying to, like give him a break. It doesn't work that way. And you'll think to need to set up a plan so that the business interest is transferred quickly and without incident. This is important not to hinder the success of your business. Conflicts between heirs and continuing owners can be consuming and very expensive. So you want to make sure all of this is addressed early and often so that everything runs smoothly. And if your company is not currently in a position to be sold, perhaps some actions can be taken now to help make your company more marketable. There are a lot of T's to cross and a lot of I's to dot. Once you have a successor in mind, the next step is to ensure that your successor is in a position to take over the company by creating a buy-sell agreement. The choice of a buy-sell agreement in part depends on many different factors. The type of your business entity is one. This is not a one-size-fits-all scenario. So as far as types of businesses, you have your C Corp. There are two levels of taxation in a C corporation. The corporation pays taxes on income minus the expenses, and the distribution to shareholders are also taxed at the dividend rate. Liability is limited to the assets of the corporation and not the shareholders' assets. Now, this differs from an S Corp. The entities are characterized by a what they call flow-through taxation, and income is only taxed at the shareholder level. Liability is limited to assets of the corporation, not the shareholders' assets. Then you have partnerships. This is also a flow-through taxation strategy, and income is taxed at the partner level. Now, there's a slight distinction. For general partnerships, each general partner is personally liable for the business debts and liabilities. However, in a limited partner arrangement, the general partner is personally liable for the debts, whereas the limited partner's personal assets beyond investments are protected from the company creditors. And the most popular of the list is probably your LLC, the limited liability corporation. This also uses a flow-through taxation methodology. Income is taxed at the member level. Liability is limited to the assets of the company and not the member assets. In general, there are three basic types of buy-sell arrangements. You have the cross purchase, you have the entity or stock redemption approach, and then you have the hybrid, which is the wait and see approach. Now, carefully look at the diagram ahead of you. This is a breakdown of the cross purchase method. First, stockholder A and stockholder B enter into an agreement, and this agreement is with each other, and it pertains to each other's death, their interest at death. So if A dies first, B will pay A's heirs for A's shares. A's heirs will transfer that stock back to B, who now will own 100% of the business. B's basis in the business will increase by the amount of the cash paid by A's heirs. If a life insurance policy is used to fund the purchase, each shareholder typically owns the policy of the other's shareholder's life. This plan is pretty much repeated throughout the presentation. This is an overarching concept that's going to become pretty familiar as I move along. Now, next we have the cross-purchase arrangements. We have the pros and cons. Now, what we need to understand is what the attribution risks are. Attribution rules mark out the legal principle, and what it does is it helps to eliminate or prevent tax evasion or fraud. So it puts rules in place so that you don't go against the better graces of the IRS. These rules established stock owned directly or indirectly by a partnership and shall be considered as owned by any partner having at least a 5% or greater interest in the company, whether that's through capital or through profits. And it is important, especially for the family businesses where equity ownership can be a little obscure. The IRS really leans into this, and transactions involving the business or personal funds can become intertwined and a little bit mangled and intermingled. There are a number of issues to consider with the cross-purchase agreement. The pros: surviving owners receive a step-up in basis. A step-up in basis is a readjustment of the value of the business for tax purposes upon the inheritance. So assume that the business has two owners, A and B, and assume that A dies, B will pay A's estate for the B's interest. B will receive an increase in the basis of the amount for the interest. This could be very important for B if he later wants to sell the interest. And also, as far as pros go, there is no attribution issues. So everything I went on to talk about how IRS might lean on you about that attribution, that's not really a big deal here. That's not a big deal here. So that's one of the pros. However, the cons typically revolve around funding the purchase. Basically, an owner must rely on the owner to have the funds available upon the decease of the owner's death. You have to have a lot of money in the bank in order to make the purchase. If the insurance is used and several owners are involved, a cross purchase calls for numerous policies. For example, if there were 4 owners, a cross purchase approach will require 4 different insurance policies. I've seen it done, but some people prefer not to go that direction. If the agreement is funded with life insurance, the transfer of the remaining insurance death benefit of a shareholder could result in some of the proceeds being subject to income tax. There are a number of exceptions available that need to be addressed in order for workarounds to transfer with this value issue. This is where the rest of the team comes in. We will lean on the expertise of our other teammates. Now let's take a look at how the entity or redemption plan works. First, the stockholder enters into an agreement with the company. At the death of business owner A, the business would purchase the stock from A's estate. The estate of the deceased business owner A would then transfer the ownership interest back to the entity to complete the sale. Stockholder B would then own 100% of the business. If insurance is used to fund some or part of the purchasing price, the company will own the policies on the owners. Now, the pros to this strategy: with a stock redemption agreement, the business simply agrees to buy ownership interest from the deceased owner's estate, and the surviving owners will then own 100% of the outstanding stock. If life insurance is used, only one policy is needed per owner, no matter how many owners are involved. Life insurance policies are owned by the business. This is a common strategy done among the wealthy. Now, cons are when the business owners are related, attribution rules apply and it could pose a problem. These rules may take shares owned by other family members attributable to the descendants. This can cause some serious income tax issues and need to be addressed with your tax advisor in the planning stage. This strategy can also affect control. Careful planning should be done to ensure that the control of the business moves to the hands of the business owner that you want to be in charge. The last thing you want is for you to think that Jimmy's going to be in control, but it's actual Stephen. Stephen winds up in control, and that's not who you wanted because the other guy's actually better. Sadly, that can happen if you don't plan for it. Many states have rules that require corporations to maintain a certain capital level. Basically, the rules are to protect the shareholders and creditors from a corporation being jeopardized by paying out too much in cash. And also, surviving owners will generally not get a step up in basis. If the shareholder later wishes to sell the company, the redemption will not create an added basis, which may result in the payments of more capital gains. However, if an insurance is used for the redemption, the receipt of the insurance proceeds could function as an increase in basis. Again, this is something you need to strategize for in the beginning. Now, let's look at the hybrid, the wait and see model. First, the stockholders enter into an agreement with the company and with each other. At the death of the business owners A, B would have the option to purchase all or some of the shares held by owner A. If B chooses not to purchase all of the shares, the business would then be obligated to purchase the shares that remained. The estate of the deceased business owner, A, would then transfer stock or ownership interest to either B, to B and the business, or just the business, depending upon how the purchase was completed. Once the sale is completed, stockholder B would own 100% of the business. Because the business is obligated to purchase the shares from A if B elects not to, the business may choose to purchase a life insurance strategy to fund this obligation. In some instances, B may also purchase a policy if B intends to purchase some of A's interests. Now, the pros. The business interest of the deceased stockholder is purchased either by the corporation or by the surviving stockholders. By waiting to determine the ultimate purchaser, the business owner can do some post-mortem planning to provide the best outcome. The cons to this strategy is that it works specifically with corporations, and it can be a much more complex agreement. Many layers of complexity lay with this type of an approach. Now, what's the right buy and sell agreement for you? Well, it's kind of a silly response, but the response is it depends. There are a lot of variables, and this is not a one-size-fits-all approach. Each type of the business has unique issues. Therefore, it's very important to consult with your advisors to determine the best arrangement for the business and to achieve the goals that are the most important to the owners. When the owners are related and the business is a C corporation, family attribution rules are an issue, which makes redemption generally impractical. When should the businesses be sold? You might be asking. You might be wondering if it's during the life or if it's during the death. And you might also wonder if, what is the benefit if you intend to keep it within the family? It all depends. If the business will be held by the owner's entire life or be kept in the family, certain issues, such as the basis increase, might not be an issue. But in short, just as I mentioned earlier, it all depends. So you need to strategize exactly what your situation is, what your desired outcomes are for you to come up with a bulletproof plan so that everything works out silky smooth the way you want it to. A buy-sell agreement obligates someone to purchase the business. In any case, it is critical that the agreement receives or provides a clear method for determining the proper value of the business. Proper valuation is imperative. So some of the basic reasons to establish a business value include establishing a fair price for the buy-sell agreement. It is easier to set a price when all of the involved parties are alive, because once one person dies, it may be harder to get an agreement with the surviving members. It can always turn into a headache when one person dies and then everyone starts arguing. Generally, the non-related parties for the estate tax purpose and to the value will be sufficient and valid. However, when related parties are involved, establishing the value with the IRS will respect is very important, and it's much more difficult. So it's very important to get the approval of the IRS when you're ever dealing with a family business. IRS views family businesses with a heightened scrutiny and typically won't honor a below market value. So you need to get it appraised properly before you get the IRS involved. A proper evaluation is essential when gifts are made to children and or other family members. Now let's look at some of the methods frequently used in buy-sell agreements. Many agreements use a book value. Book value considers the business assets minus the liabilities. Book value can be very low as a business frequently depreciates assets beyond the fair market value, and the adjusted value helps to report the assets that are fair market value, which may give a more clear evaluation of the true company's worth. Some agreements use a appraisal by a qualified appraiser. Appraisers typically use a combination of different appraisal methods to come up with a solid business value. Some buy-sell agreements state that the parties will establish a value and then reevaluate the business each year. Now, this may result in more equitable purchase price than the formula by which you could disproportionately reflect the recent returns of the marketplace. However, the problem is generally that parties fail to establish the changes on a yearly basis. They don't meet again to reevaluate the company. So the agreement will generally specify that the absence of a reevaluation by the stockholders, you might need to bring in a professional appraiser anyway. It is important that you work with your business professionals to make certain that the methods chosen will be fair and stand up to IRS scrutiny. I can't lean into that hard enough. You have to make sure that the IRS is your friend. Once an agreement valuation has been reached, this is arguably the most important aspect of the plan, ensuring that the funds are available when they are needed to complete the phase. Without adequate funding, the best plan means virtually nothing. It's useless. So you got to have the money in order to do what you need to do. There are a number of ways to fund a plan. Businesses or individuals can use their existing cash flow. In order for this to work, the business will need to have sufficient cash flow to fund its buyout obligations, in addition to meeting the financial needs of the business. A sinking fund is a systematic savings account within the business. And you need to ask yourself, will you have enough time to save the money necessary to do what you want to do? The new owners of the business can make installment payments to the heirs, but this type of plan doesn't necessarily guarantee that the business will succeed to the next set of owners. Now, funds could be borrowed. While this is a viable option, now you're bringing in banks, and if the bank is accustomed to lending that organization money when the owner was alive, they might be a little leery of giving you money when that owner has passed on. So that's just one more level of complexity you have to deal with. You have to deal with a bank or a credit union to be on your side. And we all know how sometimes banks treat our businesses. Now, many businesses choose life insurance to fund the buyout. With buyouts at death, the proceeds are easily available in a timely manner, and it's not an issue of timing or circumstance. It's just much easier. Now, you might be thinking to yourself, what are the risks of not planning properly? The future of all parties would be uncertain, and the business could come to an end. As I mentioned at the top of the call, this happens way too much. About a third of American businesses go on to the next generation. However, if you take the time now to properly plan for a funded buy-sell agreement, you can secure that your family's future and to be confident about the company moving on with continued success. So to recap what I went over a little while ago, a properly drafted and funded buy-sell agreement with fair market value can establish the estate tax value for the business so that planning can take place and ensure that the estate has adequate liquidity. You can provide heirs with prompt payments so that they're not relying on the success of business. You can allow surviving owners to continue plans and programs established before your death. And you can address the concerns of the continued viability of the business for all interested parties. Now, we're going to take a little shift here and talk about the key employee issues. Let's consider for a moment that you're a customer, and you might be thinking that you might be concerned about getting your goods timely or in the same quality. Or if you're dealing with a supplier, they might be concerned with, about getting paid for their deliverables. If a vital person leaves, the company's lenders could be concerned, and they might stop or limit your company credit. Another issue is that the remaining employees, they might get a little antsy. They might be a little annoyed that they have to fill in the gaps when one employee left, or they might be worried about their own employment, and they might just decide to follow the guy that left. So that happens a lot. If one person leaves, you might have a mass exodus from your company, and then you're really up a creek. And that's a real issue. We see it with large corporations, and we see it with smaller companies. So when determining the amount of risk inherent with the loss of a key employee, The business owner should consider the cost to hire and train a replacement. No matter how well trained a person is or how experienced they are in another enterprise, there might be a learning curve to learn how to run your business. So just keep that in mind. Now, you might be thinking, why do key employees leave? There's basically only three reasons. Either the employee becomes disabled, they are no longer able to perform that task, he or she passes away, or the employee leaves voluntarily for a better offer, or they want to start their own business. So how does the company protect against the risk of losing a key employee? Well, disability insurance can protect the company if a key employee is no longer able to continue working due to a tragic event. Key employee life insurance coverage could be used to protect against that key person's death. And life insurance can be a valuable asset for the business in recruiting, hiring, and retaining new employees and covering the losses by a key employee's death. Life insurance death proceeds should be received by the company on a tax-free basis. And if the key person were to leave on a voluntary basis, the insurance cannot protect against that type of issue. However, it's likely to encourage the key employee to stay where they are. The company might provide various types of incentives, rewards, and encouragements to make key employees stay. And this is where life insurance can come in. Now, you might be thinking, what are some options available to the businesses to retain key employees? Some commonly used ways to incentivize a key employee to stay with the company is through a retirement and executive benefit program. There are basically two types of retirement plans. You have qualified plans and non-qualified deferred compensation. When looking at options, it is beneficial to first to compare qualified plans to non-qualified plans. Qualified retirement plans have an advantage in that contributions are immediately income tax deductible to the business and are not taxed to the employee until receipt. Generally, it's years later. Now, non-qualified plans, the business can generally pick and choose which employees benefit, can offer the individually customized plans for each. In other words, not all employees receive all of the same benefits, and the benefits can differ between different participants. And of course, some rules apply in regards to reporting the requirements, and you need to make sure that all of this planning is done carefully up front. Although not technically a qualified or non-qualified plan, other simple incentive tools will help as we discuss the Section 162 executive bonus. That doesn't quite fit in either camp. Deferred compensation arrangements are particularly appropriate for key executives. These plans have multiple purposes of rewarding highly valued executives, creating additional incentives for executives to remain with their employer for an extended period of time. And these are also good for attracting new talent. This chart illustrates how non-qualified plan can simply be used to attract an agreement between the parties. So it's just an agreement between the employer and the key executive. Although there are other forms of deferred compensation, I'd like to talk about SERPs. SERPs are particularly popular and effective at retaining key employees. A SERP is a handy way of referring to a supplemental executive retirement plan. So that's what the acronym means. With a SERP, a company makes an unfunded promise to pay executive benefits for a specific amount for a specific time. The employer receives an income tax deduction at the time the executive recognizes the income. And this is typically received sometime in the future. Most plans are subject to a tax code 409A, which basically requires a written agreement specifying the timing and the benefits and the certain reporting requirements. Now, a non-qualified plan can only be funded informally. This means that money or benefits cannot be set aside or guaranteed for a particular key employee. This is an IRS thing. That's just the way they play this game. Instead, the key employee must rely on the prudence of the contracted agreement with the employer. To informally fund the arrangement, the organization would have to basically set up three options. You have to pay the obligation out of cash flow, which is necessary, borrow to meet the obligation as they occur, or pre-funding. Many companies choose to buy life insurance to hedge their bets in this arena, so it doesn't draw from the cash register. The insurance policy does all of the heavy lifting. When life insurance is used as a pre-funding vehicle, the company owns the policy as a business asset. The insurance can provide tax-deferred accumulations and planning flexibility. At the point of the obligation arises, the organization should decide either to surrender the policy for cash, access the tax-free dollars through withdrawals and/or take loans against the policy, or they can pay the obligation out of the current cash flow and obtain the cost recovery through the death proceeds or the death benefits of the insured upon their death. Now let's take a look at the advantages of the endorsement split dollar arrangement to the employer. First, the employee can pick and choose which key employees to benefit. They don't have to cover any specific class of employees or a minimum number of employees. The employer will generate the full cost of recovery. Because the employer will receive the greater the cash value or the premiums paid upon a surrender, the death benefits will work in their behalf. The death benefit will kick in when the key employee dies. The plan provides a valuable life insurance benefit when the key employee at a nominal cost. Plus, the plan can be used as something like we call in the business, golden handcuffs, since this split dollar arrangement may be difficult for the key employees to match should he or she seek other employment elsewhere. There are advantages to the executive also. First, the key employee is provided with personal life insurance protection at a nominal cost. And next, the employer can tailor the plan to meet the key employee's individual needs for themselves and the beneficiaries. The death benefit proceeds are generally received income tax-free. That's huge. Now let's take a look at the endorsement split dollar arrangement. Let's see how that works. The business will own the policy and pay the premiums annually. The employer enters into an agreement with the key employee in which the employer will pay a portion of the death benefit to the key employee's beneficiaries. The key employee gets to name the beneficiary, pay the income tax on the current value of the life insurance as its protection to the IRS. After the death of the employee recovers the cost of the plan from the death proceeds paid to the insurance company. And the employer shares in the death benefit. The insurance company then pays the balance of the death benefit to the key employee's beneficiary as stipulated in the agreement. Another commonly used plan provides the benefits is the Section 162 Executive Bonus Plan. The employer pays for an insurance policy on the life of the key executive. The executive applies and owns the policy. So he or she applies for and owns this policy. The employee can name the beneficiary and can borrow against the cash value of the plan. The payment of the premium is considered a bonus paid to the executive, and the executive must pay the income tax on the amount of the company pays each year. The company can deduct a dollar amount as compensation. Some companies may even pay the executive an additional amount to cover the income taxes the executive may owe the IRS. Upon the death of the executives, life insurance face amount is paid to the beneficiary, and is not paid to the company. So nothing goes to the company. It is possible to add a restriction to the executive not to access the cash value policy without the company's consent. So they can't just, now this is, as an employer, this is your will. If you don't want them to just draw a whole bunch of money out of the policy before a certain date, you can put that in writing, put in those roadblocks. Now, we've discussed the SERP, the endorsement split dollar, and the executive plans. I know I went fast, and I know I'm sort of hitting you with a fire hose of information, but if you would like, please snapshot this screen or just take a picture of it for future reference. Each offers a unique possibilities for attracting, rewarding, and retaining key employees. So just take a good look at this and keep this just, for reference at a later time. Excuse me. The key is that many forms of executive benefits exist, and with proper planning, a custom program can be created to fit your business needs for your business executives. Just like I said earlier, it all depends. It depends on your special situation. So you might be asking, what's next? I know I hit you with a fire hose. You might be thinking, this is way too much information. What's next? The next step is to get started and assess where you are in the business planning process to identify areas with which you need to have addressed. It's likely that nobody is really set yet. You might not know what areas you're lacking in until you talk to somebody like me to sort of, untie this and unmangle this for you. Then you, your legal team, your professional advisors, and I can devise a customized business plan for your succession and key executive needs. Now, you might be thinking, you don't have an attorney, you don't have an accountant, you don't have all of that legal stuff. You're just a small shop. Don't fret. I have access to teams of legal expertise, tax expertise, and life insurance expertise, and business professionals who are able to provide top-notch guidance for business owners and clients with a sophisticated planning counsel. So I have access to these people if you don't have them. If you have your own, great. If you don't, over time, things change. And what was good a year ago might not be good now. So we need to meet on an annual basis to make sure that everything is still bulletproof as we initially planned it. So thank you. I know I hit you with a lot. Please take a screenshot of my name and my contact information. There is no such thing as a stupid question. The only stupid question is the one you don't ask. And if I don't know the answer, I will put you in contact with someone that does. So keep in mind, I'm the quarterback. I don't know everything. And certain experts might know an answer that I don't know, but I will be happy to find you the answer. So I'd like to open the floor up.
Well, thank you so much, Luther. I appreciate it. I know that our viewers appreciate it. Let's just see if they have any questions that come through the queue. First, I'll just say I really enjoyed the presentation, and for those that are viewing the live stream and those that view it after this presentation is over, like Luther said, you can always go back, chop it up a little bit so that it's a little bit more easier to swallow. But this is a wealth of information that I think will further position our businesses for success. And so happy that, so good job. I think Mr. Kent, he said, great job and excellent information.
Brother Kent.
Yes, sir.
Bill Clark Kent. That's what I like to call him.
Superman. Yeah. Yes, sir. So definitely great presentation. Like I said, this is something that definitely positions us for success long term. As you said, I think you said 33% of businesses do not pass to the second generation. Is that true?
Yeah, it's sad. Now, keep in mind, that's American businesses. That includes all other demographics.
Yep.
And like I mentioned earlier, when white America catches a cold, black America catches pneumonia. So those numbers, I don't have those numbers, but if I were a betting man, I would gamble that our numbers are worse. Our numbers are probably worse than 33%.
Absolutely. Absolutely. So when we're talking about legacy, we're talking about not starting over after every generation. This is where this planning and the structure is going to come into play. So just having those things in place, the insurance and all of those aspects that help us to have longevity is vital. It's like life and death, really, because we know how the game is played when we don't have economic power, and we know how things line up when we don't have the resources available. And so what you've done today, sir, has definitely provided us at least that planning board where we can consume it like an elephant. You take one bite at a time, but consume it and then start to execute it. So thank you so much. Again, this is National Black Business Month, where we're really intently focused on supporting Black businesses and helping to elevate them into a place where we have a better community-based enterprise and power, where we can make decisions that best benefit our community. Because at the end of the day, no one's going to save us. We have to save ourselves. And that goes for individuals and also collective. And so I think as our slogan says, and thank you so much, Mr. Johnson, for being on our board, we're stronger together. All right. So we got a few more events coming up this week. I think the next one is with Miss Lawana L.J. Chambers. She's going to talk about Black parity and intra-entrepreneurship. And again, Mr. Clark Kent, he said, thanks, Luther. It's all about Black economic empowerment. Absolutely.
That's right. Yeah. And everybody check out Lawana. She's a rock star. She's going to be humble. She's not going to say how awesome she is. So I'll brag on her. She is a rock star. So if you have time, please check her out. You're going to get a wealth of information.
Absolutely. Ditto that. I mean, she is amazing. She makes it happen. And she doesn't hang around to brag. She just executes and she's on to the next task. So I love it. But again, thank you, Mr. Luther Johnson, financial services professional with New York Life, and a fellow board member on the African American Chamber of Commerce. Good sir, 06. We hope that we see you again, and I'll talk to you soon.
Have a great one. Have a great day.
All right. For the rest of our viewers, again, this is National Black Business Month. We are celebrating this month. We are intently focused on supporting Black-owned businesses here in San Antonio, but across the nation and around the world. Black businesses are global. And so with the internet, you can buy anything as far as Africa to Jamaica to, Korea. We have people everywhere. And so you can support them worldwide. Keep that in mind as we move forward, not just this month, but also for months and years to come. We really have to focus on our efforts and our collective efforts. I think the dollar stays within our community 6 minutes. We have to work on that. We have to work on that every day. And so that's the message. And also when we start to work on keeping the dollar in house, now we need to start working on our planning, our business planning, and making sure that we have tools in place, as Mr. Johnson stated. This month, chamber membership, actually for the rest of this year, chamber membership, if you have between 1 and 5 employees, it's only $75 to join our chamber. What does joining the chamber look like? Well, you have a team of people, a collective of membership that's willing to support your Black-owned business, advocate on your behalf, connect you with other businesses to help expand your business. But we can't do it by ourselves. And so our collective efforts coming together to make our community better is what we are planning to do. But like our slogan says, we're stronger together. Not only that, we have micro grants that we're looking to provide to Black-owned businesses, especially those who are members of our chamber this month. I believe the application is open now. So if you go to African American Chamber SA.org, look up under the resources tab, you will see the micro grant FYI page and also the application. So again, thank you again for joining. We look forward to seeing you around, and stay safe as we get past COVID. Have a good one.